Oh my goodness. I could talk for England about the stock market, and I'm going to try to do that. But I don't know where to start because to talk about the structure of a market and what a graph looks like is nearly impossible to someone who hasn't looked at it for thousands of hours. And I'm trying to explain that when you're in the present, you've got to control your emotions to, one, not dwell on your past mistakes, not be overconfident, not be scared, don't hesitate. And then if you've had a series of mistakes, you've got to forget about that. You can't let the market upset you. This is why trading is so difficult. It's not about money or numbers or 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 fundamentals or economics. Trading is about being mindful of the present and controlling your emotions. So if anyone thinks that they're not smart enough to be a trader, they're wrong, because although the charts look complicated, they're not, and they're very simple to understand, and I understand them perfectly. In fact, I'm almost an expert in terms of technical analysis. I would say that I'm expert at it because I have a module of masters in finance, in trading and technical analysis, and I wrote a 30-page paper on a multi-indicator setup and my emotional problems, why I didn't trade consistently profitable. Okay, it was a 12-week course. I traded consistently profitable for 4 weeks, but it could have been 6 weeks except for 1 or 2 over trades that I made, which meant they were down weeks. So if I overlooked those 2 trades, I could say I was profitable for half the course. But then again, some people that don't understand charts as good as they could be profitable for the whole course because they're better at controlling their emotions than I do. And granted, I have an emotional problem, and to be exact, I have a specific mood problem, which means I can either be hyper or depressed. Well, I'm just saying I'm bipolar. And that's probably why I'm not trading very well, because of confidence, feeling depressed, not feeling positive, not believing I can do something. I'm trying to actually figure out and put my finger on why I can't trade consistently profitable right now. When for the last 3 hours, when for the last 3 years, for an average of between 4 to 12 hours per day, I've watched the markets. I've literally watched the markets on 5-minute candles, tick by tick, for about 2,000 to 3,000 hours, which is a pretty lot of candlestick patterns. Like, my computer's crashed today, and I didn't get a chance to get into my euro-dollar trade, which I predicted and understood perfectly well. And then when I saw it after half an hour of foughing about with my router, the price was too far away from my entry point, and I didn't take it. And I did have an entry point later, even if it could have been a scalping strategy that would have put me into it, or it could have been Mike Baghdadi's price behavior rules that would have put me into it. And because it wasn't close enough to my trend line, I didn't take it, and I could have put my stop water outside. Basically, if we look at what happened today at the entry point, which is this black trend line here, if I put my camera on it, is tagging or being tagged by this little green 5-minute interval. It's called a Doji candlestick. It's meaning indiscretion. The price opens here because it's green. It went down to here. Sorry, it opened here, went to a high, went to a low, and closed here. Whereas the green ones, they like open here, go down, go up, and then close here. And obviously the red ones, they open here at the open, they make a high, and they close. This candlestick, the low closed. The price closed on the low for that candle, for that 5-minute interval. Anyway, this trend line, we're going to look at this on a daily time frame that started in 2011. So we go to days. And here it is here, the start on the 10th of January. There's a test right here. There's a few tests going through it. One perfect test there. But if we go look at the trend line on an hour time frame, you'll see how accurate the trend line was and how it took a lot of time to put the trend line where it should be. And then if I zoom out, see, I spend a lot of time picking my trend lines to the pixel, because I call it the pixel problem, because every trader has different software packages. And on the 16th of the March, on this 1 hour interval, you can see that I picked my trend line so perfect that it picks almost that one, but definitely on the wick of that one. And then we come up here, the trend line is right here in this candlestick. If I can get my, for that 1 hour interval on, that's the 25th of March, this trend line went right to the hour, to the bottom of the hour. Well, almost. Okay, it's not perfect. You can see we're a little bit below it, but if we go to the 5-minute candles and zoom out, we're looking at a chart on different time frames. And then zoom out, we can still see that candlestick. We'll go to the last interaction, that candlestick. Keep on scrolling out. Okay, so there it is there. So for that 5-minute interval, the last contact before was 1 or 2 pips, or 1 or 2% of 1 cent. Anyway, if we go back to if we go back to that moment in time, we'll go to 15 minutes, and then we switch back to 5 minutes. I'm getting a bit distracted, and if we zoom in a little bit, there was lots of reasons to take that trade right there. If my computers were on, we were on the trend line, we're on the bottom of the Bollinger Band, we had a Doji candlestick, and we had unique RSI bullish divergence. This is a momentum oscillator called Relative Strength Index, RSI. It measures momentum and the rate of change. And while we have prices going down here, we have RSI going up, which is bullish divergence. We are oversold right here in the category below 30%, and we've gotten up to 35%. And I found that with my back testing, 5% is good enough to give you a hint of a reversal. So we have a reversal candlestick, we have the trend line, we have the RSI. That's 3 reasons. And I'm not sure what horizontal level there was. I think the pivot was close, but you can see we're up like, I don't know, up 70 points. We're up from 1.4050, where that low for the day was, up to 1.41190. 2 more minutes. So understanding the markets, you look at the market for its 3-dimensional structure, price and time on one way and emotion on the other way, but then you got to look at your curve. Your x-axis is money and your z-axis is, your y-axis is emotion, and there's a inverse relation between the two, so that when you're losing lots of money, your emotions don't go up that bad. You're pissed off. You're already not that pissed off whether it's 1,000 you lose or 5,000 you lose. But when you're making money, you're on this side of the curve. You're either making lots of money, not getting that much more happier. So in terms of looking at the market in the present and then trying to reference where it could go, you're not trying to predict. You're just trying to have a probability that it'll go in this direction for these reasons, but if I'm wrong, I'll lose a set amount of money. So it's almost like you're taking an algorithm in your head that's a 3-dimensional structure, price, emotions, and time on the x, y, and z axis as a cube, and you're mashing it onto a plane, which is the graph, and you're trying to make a decision in the present. In the 4th dimension, you're trying to limit your bias, which is on another axis in the 4th dimension. So in terms of controlling your emotions to make those decisions and not worry about the money, it's all the emotional robustness that you have. And because the market has structure, as I've shown you, these levels are important because it's the result of tens, if not hundreds of thousands of individual units that all know the same stuff, that they get feedback with the market and they feed into the market, and they all have bias and these problems, and they all overtrade, and they make the market turn at certain levels and hold certain levels and trend up at a certain angle with certain context, because they all expect this, because they're all doing the same thing, because they all know the same chart patterns. They have a self-fulfilling prophecy. So you have to understand that to then know where the average person is entering and exiting the market, and you just got to be careful to join the herd and enter or exit the market on average very close to that point of instability that most people do. But it doesn't matter if you get it wrong, lose a little bit of money, because you're not going to waste your money with gambling too much on any given trade. No matter how good a trade looks, you don't risk more than 2% of your capital. And I made that mistake once. I risked £3,000. I got stopped out by 7 cents. The market rallied after that, and I would have made £6,000 that day. And then the market went up 300 more points, and I was trading £700 at the point, because we went up to the 2011 highs, and I got stopped out on September 7th. Basically, what I'm saying is that 7 US cents costed me a loss of £3,000. It would have been worth £6,000 by the end of that day. That would have been worth like £250,000 at the market high if the position was still open, because I bought the contract that was the late quarter contract. I paid an extra premium for a spread bet position that was had a 3-month expiry period, because I planned to keep the position during the third quarter 2010 earnings season, because I expected a rally, and I expected the market. I expected companies to give good earnings and the market to go up, and I basically was trading with too much leverage, and my stop was too tight, and I got stopped out, and I screwed up trading after that. I became risk adverse and became really hesitant to trade again. And even now, risking 2% is like risking 20%, because I have that what if of the £250,000 I would have made had I used my money better, such as if I traded £600 to the point and had an extra 4 ticks to my stop. Like it's just silly, that margin of error of the width of your hair to get stopped out by and lose that kind of money because you do something stupid and overtrade. Anyway, so no more overtrading. I must believe in my analytical ability. I must stay focused and eliminate my bias and follow my algorithm that I've written for high probability trading. And I gotta trade better, because my life depends on it, because this is my future, and I'm so bored of being a physio that I can't do it for another day of my life. If that makes any sense at all. To anyone who understands trading. Was I just waffling? Well, let's look at the S&P entry point. We had another bias today. We thought that the S&P wasn't going to break this trend line here. This is a 5-minute candlestick. Well, lo and behold, we did break it, and we got above it. And the previous example was the euro dollar, but this is the same kind of mistake I made in the E-mini, the S&P 500 index. We got a down trend line coming across the highs right here. We got a fib level from the high to the low, and it came right into today. So we go back to the 5-minute candlestick. You can see that the market bounced, and if we zoom out, I know we got like 20 seconds left. The market bounced off that fib level that I never had on my chart. It's uptrending nicely, and it broke the trend line, which I shorted here. And if I use my algorithm for buying a third contact, we above the moving averages, we would have had a breakout of the trend line in this green candle, then we would have bought it 1 tick above on that green candle right there, which is a scalping technique that would have put us into that last move right there, which is from 13.16 up to 13.23, which is a nice 5-point move. So if you can, if I was being mindful about being biased, I would have taken that based on my algorithm to trade.